Ryan?
Good morning, everyone.
Okay.
You all right?
Good morning,
What's
mate.
up?
Yeah, we had some weird noises when your audio went on.
Oh, I've just switched my mic on, so I don't know what that was. Is
Right.
it all right now?
Yeah, it's all right now. Please proceed, mate. Good morning.
Yeah. Okay. Cool. Yeah. Well, good morning, everybody. Into a bit of a chop fest today in markets. Bit of washing machine action going on today. So we'll cover some of that quickly. Some of the, as we usually do, the news items, some of the data that's been out, and then we'll get stuck into some of these price moves and what exactly is going on. One of the big items today or from yesterday is from Switzerland, the S&B's Jordan. A bit of a weird one, really. He came out with some comments saying that they stand ready to act on any inflation problems, which the market has taken quite hawkishly. This is pretty strange because he said pretty much the same thing end of April, and the market really didn't move at all on it. So we've seen this big move in Swissy pairs, which we'll look at in a bit. But really, it's well, let's throw it up now while we're here. But really, it's as I say, it's a bit strange because he said this at the end of April, and it seems like the market pretty much ignored it. If you look here, that's round about 28th, I think 28th, 29th is where he uttered the comments first of all that they stand prepared to act on inflation, and that didn't budge the price at all. But here we have off nearly well, pretty much nearly 200 pips, over 200 pips. So a big move there in the Swissy. That's something we'll talk about a bit further. China, looking at the old Shanghai situation, they're easing a bit more. The vice mayor or someone in Shanghai said the port had resumed 90% of cargo handling capacity. So further signs of easing up there. That will potentially help with the supply chain backlogs, but that's going to take a long time yet to unwind. They're also looking to get more general things back to work, but they're looking at early June for that. So there's still going to be some drag there, but it's slowly moving in the right direction. Over to Australia, we had some data out overnight this morning. Let's see if we've got it here on the right page. No, today's. So the unemployment data, here we go, came out. The unemployment change missed expectations, coming in at 4K versus 30K expected. But a lot of that is to do, if we look at the breakdown, there was a big flip between the full-time and part-time unemployment, a real big switch there. Full-time unemployment rose by 92K and the part-time dropped. That's a good thing you want to see in the jobs market, and Canada tends to split the part-time and unemployment numbers up as well, because what you want is a good trend of people changing from part-time work into full-time work. That gives you a sense that there's more strength in the jobs market. And I used to joke about the Canada data because it was like a revolving door. You know, 1 minute full-time employment was up 50K and part-time was down 50K. Then the next month it would flip and go the other way. What you want to see when you're looking at these types of numbers is a good, strong trend one way or another to judge how the market's going. Now, the unemployment rate fell there. And it's shown up there, yeah, 3.9%. It was revised low, so it's pretty much unchanged, but a lot of people are saying that it came down a point versus the revision. But what we saw here was the participation rate dropping, and that can lower the unemployment rate. So it gives a false sense of the metrics there. That's something I look for in the NFPs and have done for quite a while now, because while we've been getting this strong run of job gains, the headline NFP number, the unemployment rate really is all about the participation rate. Because we've got quite a lot of people out the jobs market, and some of those people are not looking for work at all. So you have people who are looking for work, part of the jobs market, and then you have those out of the jobs market. That's what the participation rate, it measures the number of people who are actively looking for work. They may be unemployed, but they're actively looking for work. And so if you see more people coming into the market participating, that can sometimes lift the unemployment rate. Conversely, if people come out of the market, that can lower the unemployment rate. So when you look at jobs numbers, when they give a participation rate, you need to take that into account. a perfect world, in a perfect world, you want to see job gains, you want to see the participation rate rising alongside the unemployment rate falling, because that's telling you people are coming into the market and they're also getting jobs. So the unemployment rate there in Australia dipping, but the participation rate could be something behind that. There's nothing much out in Europe and the UK, so we'll skip over those for the moment in news-wise. The big topic that's been on the market's mind and chatter, particularly yesterday afternoon, was the awful numbers from Target and Walmart that came out yesterday. That's really put a big damper on views of the consumer. That's following the half decent retail numbers that we got the day before that. Now that's playing into this stagflation theory that's picking up, the chatter around that is picking up. So big questions there over the consumer because of these earning numbers from Target and Walmart. But I want to highlight something that Stelios threw up in the room, a tweet from Kathy Wood of ARC. Most of it's a load of rambling rubbish, but one point that did stick out for me was that she was saying that there's been a big inventory build, particularly at Target. Now, when you're talking about inventories in general terms, rather than just for a specific company, this can affect activity, it can affect GDP, because what happens is if you get a big inventory build, let's say in the manufacturing industry, that signals that there's a lot of activity at one moment, and then that may drop off because everyone's filled their shelves, if you like, and then so activity drops off later down the line. So it can cause a bit of an imbalance between what's happening now and what may happen in the future. And that's pretty similar for what's happening, let's say at Target. If they're building up inventories, taking in a lot of stock, the question they're going to have is, right, they're not going to be perhaps ordering as much further down the line. But if the consumer is getting weak, these guys are potentially filling up their stock levels, as we know, at high prices, because input prices have been rising and rising due to supply chain issues. And now all of a sudden they're going to have a lot of stock and a potentially weakening consumer who's not going to be willing to spend as much. Now you've got stock at high prices and you've got to do something to get rid of that stock. So that's where you get an imbalance. And perhaps, you know, if things go that way, you're going to start seeing prices coming down at big stores like this because they want to shift the stock now. And then they're not going to order as much anyway because the consumer isn't buying as much. So from an earnings perspective, you've got that effect there where, you know, it's hard to see that retail outlets are going to start boosting their profits anytime soon in that scenario where they're pretty much buying high and selling low. But also that knocks onto the overall economic effects for economies. You know, you're going to get that hit to GDP, you're going to see that weaker consumer, and it's all going to creep in. So that's something that stuck in my mind regarding the Target and Walmart stuff there. We also looked at housing yesterday, and I mentioned the NBA that was just coming up about an hour after the show. Another collapse there. Let me find it again. Where are we? So here we have the NBA. This is a weekly number, as I mentioned yesterday. Mortgage applications dropped 11%. That's a fairly big number. It can be quite volatile. I've seen sort of 7, 8, 9%, but 11% really stuck out in this one. As we can see from the other indexes there, the purchase index dropping a big whack. The refinancing index also dropping. The index overall dropping. And that was even while we saw the effective rate dropping slightly to 5.49% from 5.53%. Now, as I mentioned yesterday, this is something we've been watching for pretty much since February, March, and it's been heading south since then. It's really been highlighting some issues coming, and it hasn't stopped. Now, we got the housing starts and building permits data out yesterday as well. This is for April. Again, it's showing a fall, not a huge fall. You know, in permits, we fell from 1.879 to 1.819 million. Housing starts here, missed expectations, falling from the prior month, you know, only by sort of 4,000, but this number here, the prior number, was revised down. It was revised down a good chunk from there. I think it was 1.77 something. So although it looks like a small miss on the prior, there was a big revision to last month. So maybe we're starting to see some of the weakness that we've been watching in the NBA creeping into the main headlines in the housing data. Obviously, we got that poor NHAB number, which was a May number, a terrible collapse there. So the themes are starting to build for the US economy. You know, we want to look at and see what the consumer's doing. Is the consumer going to get a big hit? Is housing going to get a big hit? All these little areas and sectors and signals, if they start trending, we're going to start seeing the problems coming in, the stagflation problems coming in, the market then questioning, is the Fed right to continue hiking? Is the economy going to suffer more than they're expecting it to? And then we're going to get the price gyrations because the market is going to be second guessing the Fed's moves. So a lot of mess to come from all the data that we're going to see in the weeks and months ahead. Now looking at today's calendar, not a lot really. The pick of the numbers, jobless claims, we'll keep an eye on to see what's going on there. Any weakness in the numbers there, but it's all been sailing pretty well along there. Philly Fed manufacturing, the second manufacturing number of the new month of May. If you remember, we saw the Empire State collapsing on Monday. That was a real big drop there. This will be another small indication of whether manufacturing is hitting some problems as we enter May. 16 expected there from a prior 17.6. The Empire was expecting a positive number and it came out a negative. So just something to keep an eye on. You know, it's not something you put your house on these numbers, but it plays into the picture. It builds up the fundamental picture that we look at. Also, Canada PPI. We had the CPI data. When did we have the CPI data? Was that yesterday? I think. Let's have a quick look. Was it yesterday, Kay? Yeah. So let's go back and have a quick review on that. Pretty much held up fairly well, CPI in Canada.
That was shot a little.
Yeah, it was, but we saw as I said yesterday, they've got like 30 numbers to try and guess their CPI. So overall, it edged up, particularly year on year. So it's going to keep the Bank of Canada on their path, on their hawkish stance, and looking at further rate hikes and see how the rest of it does. So PPI today will just add to that picture a bit more or subtract from it a little bit. PPI numbers tend to be a bit more volatile. When you're looking at numbers 18.5%, that sort of thing, raw materials 42%, it is a volatile number. So you can see some big swings here, but as usual with a lot of this data, it's all about the trend. Our prices continuing to rise, and that's going to feed through. So that's it from the news and events pretty much today. As you said, going back and having a look at the Swissy, looks in an awful lot of trouble. That's a really fairly big move. There is a bit of risk off in play today, and I think a lot of that is being driven by yields. You look at the yield space here. Pretty much everything in the red. Take a look at the US. We're in a fairly decent support level, or one that I've been looking at. I was looking at on the way up round about this 2.8 area. Yields hit their head up there when we came up, and then it was a bit of a pivotal area. We're trying to find some support here, but if we get a break under there, that's going to potentially add to these risk off moves, and we're going to see the dollar suffering. But it's a bit of a, as I say, a bit of a washing machine at the moment, because we're seeing things like dollar yen suffering. But
Ryan, can I add something about yields quickly?
Yeah, go ahead, mate.
In prior economic cycles, most of the time there's like one or two big blocks sticking out, being on the move, like either the US economy doing well or bad, the European economy doing well or bad, for instance. So we will see a lot of gaps open between yields from one to the other block, but we have seen in this cycle, they're all pretty much moving in tandem, even when the Fed started to talk about hikes and the US yields were shooting higher and the ECB was still on their dovish stance. European rates still went up. So we have to, it makes things a little bit less easy to, from a trading point of view, because one block is not completely standing out versus another. You have daily swings, like we have seen in sterling, for instance, when the numbers were better, helping to drive the cable higher. But for instance, but it's a little bit less obvious to trade this cycle. And if you bring it over to FX, which you will talk about, it does give the impression sometimes that FX is stable, but partially it's because of the yields are moving in tandem one with each other a lot of times.
Yeah, and then, you know, because when you get all yields moving, then the market doesn't really know which way to go when it comes to FX. You know, do you sell the dollar, or do you sell the dollar on the move low in US yields, or do you buy the dollar on the move low in European yields? So that's why we get this sort of, we call it a washing machine effect, where pretty much the market, you know, is trying to go all ways at once and not trying to go anywhere. But that's what happens in these situations. You know, when you talk about fundamentals, you talk about expectations for central banks. You know, as much as it can be hard to guess or fathom when a central bank is going to move, when you get a change in expectations, you know, the Fed going from dovish to hawkish, it's pretty simple. You get the change in expectations. Everyone knows what they're doing. The market knows what it's doing. It moves accordingly. But when you get to the end of that road, and now you're throwing in all these different questions: can the Fed sustain a hike path? Because is the consumer starting to turn weaker? You know, we're seeing earnings for retailers coming in weak. You know, then the market starts to question things, and then you get a situation where there's more questions in the market's mind than there are answers, and that's reflected in messy moves, because one day you get a good piece of news and yields jump and everyone's happy and rosy, pretty much like we were beginning of this week. Come a few days into the rest of the week, stocks are crapping out, yields are crapping out, and you know, it's all a bit of a mess. Unfortunately for us traders, it can be very difficult. And you know, one of the aspects you use for that is you just lean on your levels in the charts. You look at your ranges. You be very careful if you're trading short term, because you might get flipped in and out in some of these moves. But one way to get around that is look at the wider time frames, or wider time frames. You know, rely on the bigger levels, the wider levels, the ones that may be a bit more stronger, and you know, the ones that are going to form a barrier if you get some of these intraday moves hitting against them. But as we say, you know, it's looking a bit messy out there. You know, we take a look at the S&P here. Let's come out a bit. You know, we're just on the futures market and the CFDs. You know, it's looking a bit ropey out there again today. You know, Blake and the guys are in the room have been touting that 41 level as a strong level and pretty much nailed it on the highs, and you know, decent move south on that. Technically, you know, we're coming to the 38.2 fib of the move up from last April. We'll call it the virus bounce. That's going to potentially be a big test. Can we hold it? Can we break it? Who knows? But the mood is very, very much sour at the moment. But it, you know, it's only going to take a couple of positive headlines and things will flip around again. But I think the trend, as we can see, is well entrenched now. It's definitely a rally selling stocks rather than a dip buy, which is what a lot of the market and a lot of retailers are going to have to get their head around. You know, the buy the fucking dip doesn't seem to be working right now, and so you've got to look the other way. But you can't go too far that way, or you get in trouble. Now I want to have a quick look at oil. Bit of a funny story here. I noticed this just for anyone who uses TradingView. There seems to be a little, I use this feed from TVC. There seems to be a little bit of a wonkiness going on here, because I don't know if they fixed it yet, but it's they seem to have had two feeds coming into this. So they've got the feed from the new month, but they also seem to have the feed in there from the old month. I think it's stopped now, but it was flipping between, the price was flipping between 105 and 108, so just jumping up and down. It looks like they fixed it now, so it should be okay. But it reminded me of a story some years ago when I was working in the city and I was trading my own CFD account. I don't know why, but I just happened to have coffee prices on the screen, and I was watching this futures month for coffee, and it was trading 67.30 at 40, something like that. And then I looked at it again, and it was 68.50 at 60. You know, I was okay. That's a bit strange, bit of a jump. Something's gone on there. And then in the same instance, it jumped down. It went back down to, 67, 80, 90, jumped up 68, 60, 80. And I was looking at it thinking, what's going on there? And it kept happening. So the price kept jumping. And I thought, right, well, there's a little arbing opportunity. It's got about a 50 pip spread in it. So I'll buy it when it drops, and I'll sell it when it goes up. And I pretty much caned it. And I think I was up about £25,000 just jumping in and out on this price mismatch. And then about half hour later, I got a phone call from the broker saying, sorry, we've got a bit of a problem with our feed. We're feeding 2 futures months into the same contract month, hence why the price was moving. Asking me nicely to let them off the trade, for about 25,000. Now, I would have been quite within my right to say, jog on, I've made that money, you've priced it, that's your fault. But there's a little bit of, how should I call it? There's a little bit of ethics and morals when you're trading, and there's something in markets called scumming, and that's where you take advantage of a very poor situation and pretty much mug someone off. It was really frowned upon on the live floor if you're trading the pits. If you were standing there shouting out a bid and offer, and you'd been there for half hour waiting to, trying to get filled, and the market started trading, and someone comes in, walks in the pit right in front of you and takes your offer, takes your order, that's classed as not really good. That's classed as scumming. The other side of the coin was that these guys were a customer of the company I was working for, G&I at the time. So it was in my better interest to let them off and get some good faith. It was a mistake. It was a proper mistake. So I let them off the trade. But I made sure that the guy I was speaking to, I got his name, because the next time I had a nightmare, I gave him a little tinkle and he'd let me off a trade. So it's all swings and roundabouts, really. But it's these little things you can look at sometimes in pricing. You get these little anomalies and, have a go at scumming them if you like. So let's have a look at some of the other pairs going around. Let's have a quick look at cable. Again, still very messy for me. It's up, it's down. It doesn't really know what to do. I don't really know what to do with it at the moment. It's in a world of its own. We got to move down. As I said yesterday, I was looking around the sort of half marks, the 50s and the double O's as the main support and resistance areas. We broke under that 123 sort of 45-50 area, went a little bit lower, but we're back above it now. Hitting our head on the 124 now. We had a little move above, a few pips, but it can't get and hold above there. So we're potentially going to be ping-ponging this range until it decides where it wants to go next. Again, taking it on the wider view, as I mentioned earlier, if you're worried about getting caught in the middle here, push out to your wider levels. We've got the main support down here and the big resistance up here, 125. So if you don't want to get caught in all the chop, just have some patience, sit back and look to trade the bigger levels. Euro dollar we'll have a look at. Looks to be sinking under this 105 area again. The moves back above are fleeting, so that's going to keep potential pressure on the downside unless we can get back above and hold back above the 105 area. Some of the minor levels that I mentioned yesterday, we've got that 80 level. I'll mention the 20s game, we call it, where there's levels every 20 pips down. We're looking around about 80. Again, we got a break underneath it. got down to the 60s, held the 60s, coming back up now. We're potentially holding the 80s again, but we can't get above this 105 zone. So the pressure is still on this one. I still think it's a dip buy, and that looks pretty obvious when you're looking at the price action yesterday and today. But whether we get a few more panic moves today or the market getting really risk off, we're going to need to look at what this does. And if it comes all the way back down and test that 104, gets under 104, we're potentially heading back towards those lows again. But yet again, if you want to come out of the noise, look at this 105 level here. You can still try with shorts there. You don't need to bet the farm on it. A stop above 105.20 maybe keeps your risk fairly low. Conversely, look at maybe the 104 level, maybe even down to these lows for looking at longs to try and play the range. We'll have a look at dollar yen next, because this is looking particularly weak at the moment, mainly looking like, as I say, the bit of the risk off mood and following these yields, particularly in the US. So breaking under the 128, and I was just joking in the room the other day that I really had an itch that I wanted to be short this, and I was looking for a move up to 130 to start getting into some shorts, but we never got there, and I'm left waving at the boat as it leaves the dock. But that's trading for you, I suppose. But it is looking a bit susceptible at the moment. We could very well get a test of this low 127s, and that's going to be very interesting. It's when we're talking about these wider ranges, 127, 131 is what a lot of us have got our eyes on. So if we get a move down there, I'm going to potentially be looking at longs, and but I'll judge that move at the time, see what the news or events are behind it. But if you're looking for big levels to trade, that's one of your ones to look at for this pair. Kay, you still long, or you're looking to?
No. I closed it yesterday, right? I didn't like the move the day before yesterday from the high 129s down. It looked a little bit strange in the way it happened. So I killed my longs just above 129 before the bigger collapse started. I have the impression some of those moves we have seen have actually been started via FX. Like usually you see yields come off, then stocks come off if it's risk off, and then FX follows the move, since all those yields and stock moves create FX moves. But it seems that FX took the lead on that one. So I suspect a few big boys or girls must have been around selling the FX first and knowing what they would have to do in the other markets. So I killed it, and I'm really sitting on the sidelines now, because I don't know exactly what will happen in the next couple of sessions.
Yeah, so it's going to be very interesting. I think the US Open is going to be particularly interesting to watch. We're going to see futures crashing or stocks crashing again. What we have got is, obviously, we've got the OPEX this week, and something else just to throw into the mix. There's a company called the MSCI, and they are a big global benchmark for hedge funds. They do a lot of analytics, and a lot of banks, hedge funds, you name it, investors, large investors, they use these MSCI benchmarks for their holdings, and they rate them in their indices. So what happens is, twice a year we get the MSCI index. They revalue what they're doing, they rebalance what they're doing, they take stocks out of their indices and add stocks in based on whatever metrics they use. And because a lot of these big firms and big investment firms use the MSCI, so they will have holdings that follow the stocks that are in these indices. So when the MSCI shifts stocks out, you can get investors and funds shifting their portfolios as well. So they will sell the stocks that are coming out the index and add in the stocks that are going in. Now this affects a broad swathe of the market, ETFs, everything like that. and it's something that we found upon a couple of years ago, I think it was, Kay, and there was a huge move in the China stocks.
Yeah.
There was something like, I think, 800 stocks coming out of a particular index that they use, and that caused a big wobble in Chinese stocks, and that the market didn't really know what was going on. That led to some moves, reverberations in other markets. So this is something that we pick up, and then I'll show it to you in the chat room because we put it up. Let me have a look. 2 seconds. I'll just go and find it. Where did I put it?
I think if I recall well, that time it really moved a lot was from, it went replaced China stocks with Japanese stocks or so, and both.
Yeah, there was a big rotation
moved really a lot on them.
So this is it, and they do have quarterly, but the reviews, but the big one is the semi-annual one, which is in May and August, if I'm not mistaken. So this came out the 12th of May, and it's effective the 31st of May. So as you can see, they have all these different indexes for different countries: global, US, China, Japan, UK, all sorts of different ones, and it's these additions and subtractions. So say here, there will be 477 additions and 106 deletions. Now, if you're a big hedge fund and you've got stocks and you're using the MSI metrics and benchmarking, you're going to potentially be adjusting your portfolio. So you're going to be adding these stocks in and taking some of those stocks out. And where you get a big imbalance, or where you get a lot of moves, then that's going to affect stock markets, because we've got BlackRock. Was it overnight, Kay? BlackRock doing a big change in their allocations.
Yeah, it came out yesterday afternoon or late in the day. Yeah.
So this is something that also could be in the mix regarding what's happening in stock markets at the moment. Now, a lot of these are pretty even on the ins and outs. 490 and the small cap, 490 going in, 330 coming out. There's not too much of an imbalance there, but these numbers are sizable. Sometimes it's only 50, 60 going in and 30, 40 coming out, but we're talking we're in the hundreds here across a lot of the indices. So again, that can add into the volatility we're seeing in stock markets. It's not really something that you can trade unless we see a really big shift like we had last time, where we saw a big move out of China and into Japan, and that caused a real mess in stock markets, as Kay pointed out and I pointed out. So this is just another thing we keep an eye on the semi-annual reports and the annual reports, just to see if there is any big changes. But there's a lot of stuff going on here that could be playing into markets. So that's pretty much it as far as looking at prices goes. I'm sitting on a couple of trades still. I'm sitting on my hands also. Some of these moves, I tried catching a knife in Euro Swiss yesterday at 104, lost 25 pips there. That looks like a good trade now, seeing where it's trading now, 102.59. Got a little bit of movement in dollar Hong Kong. This is one we've been talking about. I'm short here because we did knock up against the band. The Hong Kong Monetary Authority, for those that don't know, have a band in place for their currency, dollar versus Hong Kong dollar. 7.75 to 7.85 is their band, and they will defend it at every edge. So we had a little knock up here, and it's a low risk short in my mind, so I've jumped in there. I'm a 20 odd pips in the money in that, so we'll see where that goes. I'm looking at 7.82 for a partial profit take if we get down there. Dollar yuan, again, that's getting a bit of attention at the moment. A few news agents are highlighting that there's a record number of shorts in the yuan at the moment, which potentially may cause China and the PBOC to start upping the rhetoric on not giving people a free lunch and how they're not going to let the currency get too far away from them. So we could start getting a bit further rhetoric up there. I did leave some orders in, a couple of orders in overnight to go short at 6.80. I've pulled those this morning because with this risk off move, it could well be that we get a push up. So for today at least, I'll look at maybe trading it manually if we get a move up to 680, maybe try and push for a bit higher. Stop above that big fib that we got up there around that 6.85 number. Just zoom that out for you guys. So that big fib that we're watching up here, which is a level in itself, you know, around that 6.84, 6.85. Apart from that, I'm still a little bit long. Euro dollar 104.29.
Just to continue, just to finish rather on the yuan. I saw a report come out that PBOC actually bought yuan in the month of April when it all started to boot off and accelerate for the yuan to come off. But yeah. Okay, they haven't done much. I think it's about, what is it, $3 billion, which is in the bigger scheme of things, nothing spread over a month. But to try to calm, or to not to put a break on it, but to show to the markets that they will be watching. And it's likely also one of the reasons why they did not change the MLF rate this month, because the yuan really accelerated lower. So it's interesting because the months prior, they were actually selling yuan every month. So we have to look at a few things. Unfortunately, we only know those numbers nearly 3 weeks after the prior month is done. But just something to keep an eye on.
Yeah, and we also had the Chinese insurance and banking regulator also saying that moves in the yuan aren't going to be one way forever. So, you know, that was a low ball rhetoric, bit of jawbone in there. Hence why I'm particularly looking at taking the short side on here at the moment. But we'll wait and see what happens with that one. Let's have a look. Are you guys and girls got any questions coming up? Let me have a quick look through the chat. We did have a couple from yesterday.
Ryan, there was an interesting one just right now from Gavin, saying that the Met have finished their Partygate investigation, so that could mean that the Sue Gray report comes out very soon. No mention of any more fines for the PM, but could have sterling implications soon. Just quickly to reply on that, maybe Ryan has a different view on it, but I find that the market has been completely ignoring fines or stuff, which is it might have done ahead of all the events, but since really they started to talk about stuff, it's really been more about the Bank of England and how they handle the situation and the sterling, the UK economy, rather than politics. Do you have a different view on that, Ryan?
Yeah, I think it's largely ignored. The main risk from all of this is whether Boris resigns or not, because the market doesn't like uncertainty, it doesn't like big change. There's lots going on. You don't want to start having leadership contests and everything like that. It doesn't change, you know, if the worst happens and Boris resigns, it doesn't change what happens to the country because the government is still in place. It's only a leadership change. It's not a party change. It's not a general election, anything like that. And even if Boris goes, the favourite to take over is Sunak, who is pretty business positive and will be taken in a positive sense from the market. So as you say, it's not, market's really not looking at this unless it comes to the point where Boris resigns. That'll probably get a bit of negativity just in the short term. But for the longer term, there's far more bigger fish to fry than whether Boris had a bigger bit of cake. So yeah, quite right. Okay. So yeah, one of the questions yesterday was Arif on summer markets. Yeah, the old saying, sell in May, go away, come back St. Swithin's Day. One of those old lines from many years ago. These things happen. It depends on what's going on in markets. You know, 2018, 2019, you could have quite easily laid down the sell in May, go away. Volatility was really low. You know, we were watching 10 pips a day in dollar yen, even euro dollar, 15, 20 pips a day. It really was a snore fest. We're in May now, and what have we got? We've got economies, we've got central banks changing monetary policy, we've got high inflation, we've got stagflation risks. You know, there's lots going on. You and I are not disappearing anywhere soon, and lots in the market aren't going to disappear anywhere soon. There's far too much going on. You may get a little bit of a lull as we maybe get into the summer months, as you tend to do when everyone starts packing up and going on holiday. Governments go on recess, central banks go on their jollies to the beach. Lagarde tries to get a real suntan. She probably goes to the North Pole. Yeah, it's one of those things. It's like summer driving season in the US. You know, always widely tipped as one to watch for oil markets because everyone's jumping in their cars and driving around. But in this day and age, it's not as simple as that. There used to be something in the UK called Factory Fortnight, which is where all the big factories and industrial areas around the country would close down for 2 weeks, which actually in those days would impact data because you've basically got a big drop off in manufacturing and industrial activity. And so the next month you'd usually see a drop in the numbers because everywhere was shut. But that's in the old days. You know, you don't get such things these days. Everyone runs 24/7, 365 days a week, a lot of the time. So all these old things and flavors that we used to get don't really come out these days. Just want to jump back to let's have a look at some of the other comments here. Dale, I was at GNI in the late 90s. I was on the touch futures. So if you were there then, I was dealing with touch futures and margin and stuff like that, and probably chasing guys like you for money and helping you out with your dodgy trades. But that was me back then. Let's have a look if we've got any more.
Anne about $CAD.
Yeah, let me get there in a second.
I reply to it quickly because it's Anne is from down under, so it's already late over there. We won't keep her too long.
Okay, yeah, let's get the latecomers in. Okay, right. $CAD, we're hitting ahead against this zone that, again, something I've been looking at for quite a while. Pretty big zone from sort of 129 up to 131. Again, I'll be looking for perhaps another move towards 130, but that might be a bit greedy. This seems to be in the mix of the risk on, risk off oil. So it's a little bit undecided here. We're setting up a little bit of a short-term range. 128, 129 seems to be the ballpark. I think it's going to take a break of either side, and we'll get probably a decent shove in that direction. So if we do get above 129, I'm going to be expecting it to be pushing up towards the 130s again. We do have that zone 129.50, 63. We take it down on the shorter term. You can see, where are we? So again, a zone within a zone. This is an area that we had over the last couple of weeks, which, you know, a bit pivotal. We had support, had resistance. One of the main places I'll be looking at to see if we're going to have a push up, can we get through that level? If not, we're potentially going to be heading back down. Conversely, it looks like we're going to need a break of this 128 properly to get a move probably down to the low 127s once again. But overall, the theme here is generally, as we've been saying earlier, a bit more of a washing machine situation. You know, 1 minute you look at it and it's trading up there 129. Another minute you look at it, it's low 128. So a lot of indecision here. Pick your levels. You know, if you don't, as I say, I'll reiterate, if you don't want to get caught in the short-term noise, pick your wider areas. You know, maybe sit at 129 and 128. Keep your risk pretty tight and see what happens to there. And if you can ride a trade, you can ride a trade. Just a question up here from, where is it? From, excuse me if I don't get your name right, Mugwana Timothy. Can I call you Timothy? That's much easier. How will this monkeypox thing affect the markets generally? Yeah, we've had some cases in the UK, and I saw either this morning or last night that there's some first cases in the US. obviously with everything in people's minds about the pandemic, when you get these types of stories, they can grab the attention of people, and maybe people get a little bit scared about it. From what I can read, yeah, it's a bit of a nasty illness, but it's not too life-threatening. And you've got to remember that there's tons of these things floating around. We've still got bird flu floating around. There's plenty of other lurgies that we don't hear about that are still prevalent. So at the moment, I'll put that in the basket of this is just the press jumping on a particular situation. Monkeypox doesn't sound like the greatest thing in the world, does it? So it's going to get you a few clicks in the news wires and in your papers. So obviously, never discount anything, but if it builds into something bigger, then we're potentially going to see moves in the market on it. But let's not go culling all the monkeys in the world just yet, though, eh? Right, any other questions that we've got? Dom, do I see a potential in further downside risk this week? Seems like the switch has been aggressive. It might have gotten people on the wrong side and took them for a ride yesterday. Yeah, I think that is a possibility. Well, beginning of the week, everything was looking rosy. You take the pound as an example. The end of last week, it was looking into oblivion. The beginning of the week, everything was hunky dory. Now things are back to looking poor again. This is the chop we have to deal with. The sentiment, the mood can change from intraday, one day to the next, week by week. Can we see further risk off? Sitting here right now, stock futures off a big chunk in the US, stocks down big chunk in Europe, bond yields still down. Yeah, you have to say it's risk off. But tomorrow we might come in, China might reopen, or some positive news from there, or the ECB might say, yeah, we're going to hike 50 pips. All it takes is a couple of headlines and things flip right around. And unfortunately, that's difficult to trade, because you can find that you end up trying to chase a trade, or you get in at levels that, with hindsight or a bit of a calmer head, you think to yourself, well, why did I get in at that level instead of waiting? And as I say, the key to it is really when you get markets that don't really know where they're going, and we don't know where they're going, and you're sitting there looking for a trade, it sometimes is often better to pull yourself out from the lower time frames, look at the wider levels, and just sit on your hands and have some patience and look to trade what are potentially the stronger levels. But that's down to, it's a scalper's paradise if you trade like that. If your levels are working, if they're not, then it's going to be a bit tougher for you. Right, so unless you've got anything else to add, Kay, we shall call that a session.
No, just to say that I've got like relatively few positions on right now, and I'm more looking to trade on a day-to-day basis against the shorter term levels, perhaps, because I'm in the bigger picture, I'm quite unsure. We were talking a lot about that stagflation and things lately, because it pops up everywhere in the market. But I really think it's still perhaps too early. The market is trying to maybe either wind down positions that they had on in a more global risk on environment, and getting out of equities. Yields are capped and coming off, so those yen positions getting scaled down. But I'm not really sure that we are in a trend yet. So yeah, we trade those this washing machine or those whipsaw or the yo-yo, but I'm not really ready to take any long-term, even risk off. I'm not feeling that ready to go outright risk off. I really think we have to look at what happens on the next Fed when QT kicks in. If the market, if other indications than housing and those inventories, and if other indicators hold up, we still might see the market recuperate and trade better than what we might expect in a stagflation or risk-off or recession environment. So I think it's a bit early to really go like, all right, now it's doom and gloom and we go down the drain, you know?
Yeah, no,
But
that's also
shorter term.
Yeah, that's also a good point you raise. You know, the market isn't just about picking a direction and being long or short. When you get sometimes when there's a bit of indecision, players can just reduce positions. They can just get out of stuff, you know, lower their risk. And it's not about picking a direction. It's just about a risk adjustment. And, you know, so some of these moves are not necessarily because everyone thinks things are going to the wall, but purely because, right, we've got too much risk on the books and we're looking at the fundamental risks and the central bank risks, and we don't want to hold as much as we were last week.
Exactly, because I mean, a lot of because us retailers, and I noticed that when I went from a bank trader and market maker to sorry to the other side of the fence, retail traders have a lot of times in their mind that it's us doing markets and people just buy or sell. But don't forget that the biggest investors in the market, they don't, in exact terms, they never go short. They up or diminish the size of their portfolios against other assets, or rebalancing, or maybe having a little bit more cash in the books because it's risk off. But they are not like, of course they will be selling, and the effect is of the market to go down, right? But we have to be a little bit careful when we talk about like big trends and big shorts and big loans and stuff like that, is that a lot, and the biggest chunk of the market, like people like Vanguard, BlackRock, whatever, they manage enormous size portfolios on risk on and risk off, but they are never short, really, because they always have investors' money to put to work. But anyway, that as an aside, we might talk about stuff like that another day. Who is driving what?
Yeah, definitely. Chris, our friend Chris, is asking about the OPEX. Do we guys pay close attention to the dates that things roll off? And also, do us less experienced guys need to follow this much? The OPEX stuff, it can flag some signals depending on if we get to hear what needs to be done, how much is rolling off. Is it going to be a big expiry, a small expiry? But if in broad terms, think of it like the stuff we get end of month, and when we get end of quarters and end of half years, and in FX markets, it's more a case of this is a period where something may happen. We probably won't know exactly what will happen. We can get maybe a fair idea of what will happen, but it's a period where the markets maybe are not going to conform to the current trends and things like that. So it's another period of instability, really, and there can be knock-on effects from that. But for you boys and girls who are in the room, we talk about this a lot. So if you're in there, please do come along and join us, and we'll get on there. Maybe talk a bit more about that tomorrow as we get closer to it. Maybe we get some information what's going on and what to expect from stocks and futures and the like. So thank you very much, boys and girls. We shall leave it there. I don't want to keep your time too long. Thank you very much for coming to the show. Hope you're enjoying it, and please let me know if there's anything you want us to talk about, particularly any subjects you want us to cover. I want to get more of your questions, so get your head in gear, get your brain boxes going. I don't want it just to be about me or anyone else. It's about you guys. I want to hear your thoughts. I want to hear what you want to talk about and the things you want to deal with. Until then, have a very good day today. Keep an eye on that manufacturing number from the Philly Fed. There'll be another clue, and we'll see you tomorrow morning. Thank you very much.
Bye, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.